Every year, millions of Americans get that sinking feeling when they realize just how much of their paycheck is disappearing to taxes. You grind all year long only to watch Uncle Sam scoop up a huge chunk of your money. And the worst part? So many people are overpaying. Not because they did something wrong, but because they didn't plan ahead. But what if you could flip that script? What if you could turn dread into empowerment and actually control how much you send to the IRS? In this video, I'm going to share 5 powerful but simple changes you can make this year to legally keep more of your money where it belongs, and that's in your pocket. And pay close attention to strategy number 4 because it's one that most investors have never heard of, and it can save you thousands every single year. Okay, the first change is we need to make tax planning a year-round sport. Most people treat taxes like a once-a-year emergency drill. They panic in March or April, scramble for receipts, and just hope for the best. By then, though, the game is over. The biggest opportunities have already passed. The first change you need to make is to treat tax planning like a year-round sport. Every financial move you make, selling investments, switching jobs, donating to charity, it ripples through your tax picture. If you're only thinking about this in April, you're leaving money on the table. Think of it like a pilot flying cross country. They don't just set the autopilot and take a nap. At least you hope they don't. They're constantly adjusting for wind and weather. Your finances need that same kind of course correction. And here's a teaser. One of the most overlooked year-round strategies is how you time your deductions. And we're going to talk about that in section 5. Done right, it's like shifting thousands of dollars from the government's pocket back into yours. Now, the second change we need to do is we need to unleash the superpower of your retirement accounts. Let's talk about one of the most powerful legal tax shelters you already have. It's your retirement account. Too many people see their 401k or IRA as just another line item on their paycheck. But when used strategically, these accounts are game changers. In 2025, you can contribute up to $23,500 to your 401k, and if you're 50 or older, you can get another $7,500 catch-up. And thanks to the Secure Act, if you're between 60 and 63, why? I don't know. That's just the rules. You can do an even bigger catch-up, up to $11,250, depending on your plan. For IRAs, that limit is $7,000 with a $1,000 catch-up if you're over 50. Now let's put numbers on it. Say you earn $90,000 as a single filer and you max out your 401k at $23,500. If your taxable income drops to $66,500, that move alone shields $23,500 from being taxed at 22% and instant savings of $5,100. And don't forget the employer match. That's literally free money. With employer contributions included, the total you can sock away in 2025 is a whopping $70,000. And here's the kick. What if you want money that's never taxed again? That's where Roth accounts come in, a strategy we'll circle back to here in a little bit. Now, the third change I want us to look at is let's turn life's biggest moments into tax wins. Life events, getting married, having a child, buying a home, they're not just personal milestones, they're financial milestones that can open the door to big tax breaks. But you need to have a plan. A marriage often lowers your tax bill. In 2025, the standard deduction for married couples is $31,500, much higher than filing single. However, it can also increase your tax bill. I don't know how many times someone has gotten married and they've been shocked at how much money they owe on their tax return. If you're getting married, you probably should contact your tax advisor to adjust your plan. What about having a child? Well, that can unlock up to $2,200 per child in tax credits for 2025. And remember, credits reduce your tax bill dollar for dollar. This is huge. And as long as they are born before midnight on December 31st, they count for the whole year. So how is that for a tax plan? If you're having a baby, let's make sure we get it done before the end of the year. Money is riding on it. What about buying a home? Well, that lets you deduct mortgage interest and property taxes if you itemize. And when you sell, you may exclude up to $250,000 if you're single and $500,000 if married. And here's a powerful bonus. Changing health plans or jobs might give you access to an HSA, one of the most tax-efficient accounts in existence. It's like a triple tax win. Deductible contributions, tax-free growth, and tax-free withdrawals for healthcare. But here's something most people don't know. Sometimes even your losses can become wins, and I'm going to show you how in the next section. Now, this fourth change is understand the power of tax loss harvesting. This one sounds technical, but the idea is simple. Turn investment losses into tax savings. It's called tax loss harvesting, and it's a tool most investors never use, and to be honest, it's frequently overlooked by financial advisors too. Here's how it works. Suppose you sold some stock this year for a $5,000 gain. Normally, you'd owe taxes on that, but if another investment is sitting at a $5,000 loss, you can sell it and wipe out the gain and your tax bill drops to zero. Even better, if your losses are larger than your gains, you can use up to $3,000 to reduce your regular income, like say for instance your salary. And any leftover losses roll forward to future year. Now, one important rule, and don't mess this up, you can't sell a stock and buy it right back. That's called the wash sale rule. But you can buy a similar investment to keep your portfolio balanced while still capturing the tax break. Now, what do I mean by that? Well, you could sell Pepsi and buy Coke, or you could sell Ford and buy Chevy. And when you combine this with the tax deduction strategy I'm about to share, the savings multiply. And the fifth change is master the deduction game. Finally, let's talk deductions. Most people only think about them when their accountant brings it up, but the real strategy is planning your deductions before the year ends. For 2025, the standard deduction is $15,750 and $31,500 for married. If your itemized deductions don't add up to more, then you're just going to take the standard. But here's the move. Bunching. Instead of spreading your charitable donations out every year, you lump multiple years' worth into one. So for example, let's say you normally give $5,000 to charity each year and you have another $25,000 in itemized deductions. That's $30,000 total. Well, if you're married, it didn't do you any good because the standard deduction is $31,500. No benefit whatsoever. But if you bunch 3 years of giving, say $15,000 into 1 year, your deductions jump to $40,000. Now you itemize, get a huge tax break this year, and then just take the standard deduction other years. Let your charity know you're going to do this, but it can really be powerful. Want to make this even more powerful? Use a donor advised fund, and we'll do a video on that as well. You get this big deduction up front, but then you can still spread out your gifts to charities over time, and that way they don't have to worry about when it's coming in. And this is exactly why tax planning has to be a year-round sport. You're not just filing paperwork, you're engineering your tax bill. So there you have it. 5 shifts that can stop you from overpaying the government. Treat tax planning as a year-round sport. Use retirement accounts to slash your taxable income. Turn life events into financial wins. Harvest your losses to offset gains. This one's huge. So many people miss this. Plan and bunch deductions strategically. Once again, so many don't do this. Remember how I promised you at the beginning that you could stop feeling punished for working hard? Well, these strategies are part of how you can do that. And if you're really serious about cutting your tax bill, I mean really serious, you need to consider creating your own year-round tax plan. Everyone's situation is different. It's up to you to take control. Thanks for watching. Don't forget to subscribe, and I'll see you in the next video.